into a unique time of year, and this is the time for taxes. Everyone hates tax season because man, you got to do something out of the norm, right? You got to go ahead and get your W-2s and 1099s and Schedule Cs and tax deductions in order, right? But one thing a lot of people forget is that now is the time to set up an IRA and still put money in for 2020, right? So there's a big advantage to that. And we're going to be talking about that. And I'm going to be kind of doing little carpet bombs across this presentation today, really mentioning why we should be going about these types of assets, why we should be using an IRA for tax deduction purposes, why we should use IRAs for passive investments, which is what we're going to be talking about today. And ultimately, like I said, it's for that time of year right now as far as the tax deductions. Now, before we dive into today's topic, I wanted to talk briefly kind of about what we've been seeing going on in the world, right? And mainly a lot of things coming up with some unique changes. So proposed, what was really cool is I got to sit in on this unique class with bills that are being proposed about changing things with the IRA. Things like increasing your RMD limit, increasing contributions limits, right? And increasing the age RMDs will happen. So if you want to talk about any of these up and coming legislative changes, just let me know. Give me a call, send me an email, and we're here to help today, okay? Now, man, Derek, how do we get started? Where's a good place if I'm a new investor, if I don't know what to do, or I'm in between jobs, I just don't know what to do. Guys, you need to get started. I don't care how it is. I don't care which custodian you work with, but you need to start something today, right? So if we use some sort of self-directed IRA, right, remember that you can always use these things for real estate assets, promissory notes, private entities like LLCs and trusts. We've seen a lot of oil and gas lately, right, and more, right? On the and more section, we've seen a lot of people investing in smaller business, startup companies. That's what Quest is here for, to make sure that you can use your IRA and invest in something that you know best, right? Something that you feel confident in, right? No longer do you have to use your IRA and your 401k to invest in the stock market, right? Where you have no control whether it goes up or down, up or down, up or down, right? You have zero control in those types of assets. Whereas the ones you see kind of at the bottom of the screen right now, you have a little bit more control. So that's kind of what we're going to be talking about today. Don't forget, guys, there's all sorts of plans that can be self-directed, from traditional IRAs, Roth IRAs, employer plans, SEP Simples 401ks, those health savings accounts, and ESAs. Now, what's unique is Quest can help you set up any one of these accounts, right? Certain ones give you a tax deduction for the previous year, right? And you only have a short window of time right now to still contribute for the previous year. So if you have questions on how to get one of these things started, please let me know. So before I bring in our next guest speaker, I want to kind of talk a little bit about him and what he's going to be going over today. But he's been a great friend of ours. He's local here to Houston. When I say he's local too, he's only about 2 or 3 miles away from our office in Houston. So it's pretty unique, right? In addition, he's a down-to-earth guy, right? And so today he's going to be talking about how we can analyze to be a passive investor. What are some of the pros to it? So what are some of the cons to it? So Feras, are you with me today?
Yes, I am. How's it going, Derek?
Boom, doing well, doing well. So I'm going to kind of, instead of talking a little bit about you and what you guys can do, right, and what you're going to be teaching, I'm going to let you do an intro for yourself, but I'm on here the entire time. So I'm just going to mute myself, shut off my video, and I'm going to let you take it from here.
Come on, Derek, we're going to miss your voice, man. So no worries. Happy to kind of help steer the ship for a little bit. So let me go ahead and get this presentation kicked off and we can get going. So let's see.
And anyone out there right now that is on the webinar, please leverage the chat box. Chat amongst each other. You guys can pitch your own investments down there. You can ask questions to the speaker, which we'll be getting all the questions answered at the end. And we can kind of go through anything from there. Your presentation looks good. I'll let you take it away.
Yeah, and like Derek said, I'm a big fan of Q&A. I tell people Q&A is probably the most valuable part of most presentations because people all have different questions. And as a presenter, right, we try to hit the key things, but we don't go enough detail to anything. I'm sure of that, right? And really, Q&A lets people ask the things that they care about. So I'm a big fan of Q&A, and really my goal is I have a pretty in-depth presentation, but my goal is absolutely to leave kind of 15, 20 minutes Q&A. So if you guys have questions, go ahead and just put them in the chat box as you have them. But with that said, I'm going to go ahead and kind of kick it off. So, really for those of you that don't know, right, today's topic, we're going to talk about underwriting multifamily deals as a passive investor. And really, it's talking about the things to look for and consider as a passive investor. So with that said, I'll give a quick overview of myself. For those that don't know me, my name is Feras Moussa, managing partner at Disrupt Equity. And I came from a tech background, and I love real estate. I love technology, right? Originally, the first half of my life was all about technology. Really kind of came up that world, worked at Microsoft, have a computer science degree, and got into real estate passively to begin with, and fell in love with it, and started Disrupt Equity, and the rest is history. So kind of amongst Disrupt Equity, we do have kind of multiple different portfolio companies, right, between the insurance management, we, peak financing, multifamily investment network, and our kind of our education piece, which is Investor Academy, but really vertically integrated multifamily real estate firm. That's our bread and butter. That's what our focus is. So with that said, really quickly, for those that also have never seen me speak, I'm pretty candid. I like to share everything that I know. But keep in mind, I'm talking about things that I think I know well, but I'm not the professional. So please don't make any important life decisions without talking to your professionals, right? Your CPA, your attorneys, things like that. So just kind of keep that in mind. But with that said, so today's agenda, really, I'm going to kick off with just kind of why multifamily real estate investing. I know Derek did a few good points about just what's going on right now with tax season. I think that's a critical piece of why a lot of our investors invest. Then I'm going to shift over into understanding from a passive investor's perspective, right? Common deal structures and returns, right? What does it mean to be in a multifamily deal, and what are the different things you can see out today in the market? Then I'm going to shift over and talk about red flags in multifamily offerings. And again, as a passive investor, what are some things that if you see to be concerned with, right? And then kind of shifting from there, really just talking about the offering docs, and last but not least, doing an actual case study, right? A couple of slides from a real deal that we did full cycle, a couple of years ago. And I think it helps showcase some of these points. So with that said, why multifamily real estate, right? First thing, for a passive investor, very little time commitment. It's very different than, for those of you that may have a rental portfolio, right? I started with rental. My first purchase ever was a fourplex. It's about 1.5 miles from our office, coincidentally. And, bought a bunch of houses and realized it doesn't scale well. And it's a lot, it's very time heavy, right? Regardless if you're doing third-party property management or not, there's still 12 loans, 12 insurance policies, dealing with tenants, dealing with this or that. So whereas multifamily investing on the passive side, it is very essentially passive, right? Is what I like to call it, right? You are essentially partnering with us, and our team, our effort is doing the heavy lifting. Our passive investors usually are just filling out the paperwork at the initial kind of kickoff of the project, wiring in their investment, and then, kind of sitting back and reading our monthly updates. And so that's really the scope of what it takes to be in multifamily real estate as a passive investor. Next thing is cash flow distributions, right? We are a cash flow firm, right? We look for cash flow investments. Other people do different things. And again, with multifamily real estate, it's a nice passive way to build up cash flow. Next up, this one's huge because we have some investors that only invest for this reason, which is you can get huge tax benefits, right? Donald Trump, whether you love him or hate him, right? He made a point early on, right, which is he doesn't pay much of anything in taxes because he's in real estate, right? I actually experienced that firsthand. I get more losses each year than I make, right? And it's as real estate. And again, there's a lot to understand around what that actually means and how to leverage that, right? But to give you guys a real example, I had one of our investors who's also a good friend of mine. He invested in a deal. That deal closed, I think it was July. And come February, right, we gave him a K1. K1 is what you get as a shareholder in any entity. But a K1 is really the tax document that outlines what your income, what your loss is for that investment. And so he got his K1 in February, and he called me and he's like, "Hey, Ferris, you turned into a white collar criminal." I'm like, "What do you mean?" And he basically said, "I don't understand how you guys closed on this deal in August. In his case, he had invested $75,000. We closed on the deal in August. We did a distribution in December. So he actually got a distribution cash flow, but his K1 on paper was on a $75,000 investment. He had a $60,000 paper loss. So he was able to take a $60,000 loss, apply that to other income, and really save a lot on his taxes. And so, that's a huge, huge benefit to investing as an investor, right, in real estate, regardless of what you're doing. And with multifamily investing, for those that are also saying, well, I get that on my single family homes. I get that on my single family homes too. But the problem with single family is you're dividing that over 27 and a half years. With multifamily, we can do something called a cost segregation study and really front load the losses. That's the example I just gave, $75,000 was about $60,000 loss year one. Next up, strong appreciation. And I think this point is going to be even more important over the next year or two, right? With COVID, I think COVID was a wake-up call to a lot of people that to kind of realize like, hey, in the end of the day, people need to eat, drink, and sleep, right? And sleep as being, hey, they need to live in a house somewhere, right? And the government's going to back that. And so I think COVID was a wake-up call to people to realize that Chili's pad site or that Starbucks pad site that maybe you're paying, 5 cap or 4.5 cap for. Yeah, great. That's really, really expensive compared to multifamily, which in the end people need to live. And so I think there's going to be a lot more money coming into the market. I'm already starting to see that and kind of hear that from people that are in more institutional space, but I think appreciation is going to pick up here. But again, we're cash flow investors. That's just gravy on the next up. Talking about basically access to strong, stable asset classes, right? You do have a big swath of investment opportunities, right? You can get into very simple, less return, but very clean assets. You can get into more heavy lifts and still, cash flow even more for that, right? Whereas with residential, there's not a big spectrum of the type of investment versus what you can get. Next up, ability to use your self-directed IRA and solo 401k. And this one's huge, right? We have about 20% of our investors actually invest through their self-directed IRA. And I mean, Quest is easily the biggest one, the most common one that we see through our investors. And, from our experience, I mean, Quest has also been the easiest one. So not really trying to give a shout out to Quest, but it's the truth of it, right? It's a very important thing. And people don't realize that, hey, that money that you have parked in your 401k, your self-directed IRA, guess what? There are ways to actually invest that into an entity and again, reap those benefits. And so that's a big one. If you guys want to know more about that, obviously you have the experts on the call. Next up, right? Deal structures. And so this is really kind of the meat of it, right? What does it mean for a deal structure? So if you're a passive investor, let's say you invest in an opportunity that we have, right? We are defining upfront how we are going to share the profits. That is really what we talk about, the structure and the split, right? And, most of the time, right, you as investors are providing the investment equity, we're providing the operations, the sweat equity, et cetera, and we share the upside. And so there's really 3 really common ways to split a deal, right? The first one is a straight split, meaning, a lot of times it's 80-20 or 75-25 or 70-30, right? Those are the common ones. And what that means is basically saying, hey, investor, you invest your money, then let's say we exit the deal, you get back your investment first, right? Our investors are always taken care of first. That's the most important rule of real estate. Please make sure any deal you're in is structured that way. But then on any upside left over, we are sharing that. And so if you're doing an 80-20, usually that means 80% of the upside goes to investors, 20% is going to sponsors such as myself, right? And so just to kind of simplify it, let's say there was $1 million invested with our investors, and let's say we profited on that deal, $1.5 million. So we gave the $1 million back to the investors. Now there's $1.5 million left, right? That is profit, and we're taking 20. Our investors are getting 80% of that. Next up is a preferred return. And so what a preferred return means is that investors get preferential treatment on the return of their investment first before sponsors get anything. Hey, Feras, what does that mean? Well, it's really not that complicated, right? Let's take a very simple example. Let's say we bought a deal. Similar example, let's say there was $1 million invested with our investors, and we sold the deal, and let's say there was $2 million left over, right? Now, we give the investors $1 million back. That's their initial investment, right? Remember, the investors are taken care of first. Now there's $1 million left over. So that's the cake that we're going to slice. And how do we slice it? Well, if we did that straight example earlier, 80-20, that would mean we get $200,000. Our investors share the $800,000 left over. But with a preferred return, what it actually is saying is that investors get almost the first chunk of return on their money first before a split. And so in that example, if we held that deal for 1 year before we made that exit, and let's say we didn't do any distributions, right? And the investors had invested $1 million. Well, guess what? If it's an 8% preferred return, right? That's the number that we've used. So let's just keep it simple. This deal is an 8% preferred return. What it's saying is that investors need to have gotten 8% annual on their investment first before anything left over can be split. And so going back to my example, there was $1 million invested and $1 million left over. right? But no distributions. Well, us as a sponsors, we need to give our investors 8% on their $1 million investment, which is about what, $80,000. We give them $80,000 needs to go to the investors first. What's left over after that is what we can split. And so what's left over after that is $920,000. And then that is being split 80-20, 75-25, 70-30, right? And so why a preferred return, right? It's one of my favorite things we put in every deal. And I think it's very valuable because it shows investors, look, we have to pay you an annual return first before we can start to get any of the upside, right? So it kind of helps give the investors that extra peace of mind that, look, not only do we have to give your investment back, not only do we have to give you an annual return back, right? But we have to do both those things before we can start to make any profits, right? And any of the upside. Next up is a waterfall structure. Why is it called a waterfall? It's kind of this shape, right? Where, it's almost like a stair, right? Meaning that, hey, up until investors get a certain return, it might be a 70-30 split. After that return, once investors have gotten that return, then these splits change. It becomes more in favor of the sponsor, right? And that's also a fairly common structure. You're starting to see more of that. And really what it's trying to say is that, look, if a deal home runs, the operator, the sponsor is going to make a lot more of that upside, right? And, we had one deal that we made an exit and 365% return to investors, insane amount of returns. That one we had done as a straight split. Me as a sponsor, I wish I had done that as a waterfall, right? Meaning my investors get taken care of up until a limit. Then after that, we're motivated for that massive upside. But those are really the three most common structures. And as I stress with any of this, please read your PPM, your operating agreements. I'm going to talk about those here shortly, but that is where these details are defined. There's a lot of nuances, a lot of creative ways people can try to change some of this, but please read that. But these are kind of the three big points if you're new to multifamily investing, or even really any real estate syndication investing. People ask, what are typical returns, right? Typical is kind of about, you're averaging about 15% throughout the life of the deal, right? That includes cash flow, that includes, appreciation or profits on the sale. Next up, for those that don't know, IRR, right? It's a very popular term, but it's also very complicated if you're new to investing. I'm not going to spend a lot of time on this. If people want to know, I'm happy to talk about it later. But all it means is that it's not average annualized return is just saying, okay, after all said and done, what did I get each year? IRR is actually looking at the velocity of my money, meaning if I give a lot of returns at the beginning, well, that's great because the investors can take that and reinvest it. It's almost like a compound interest piece. Next up, cash on cash. Cash on cash just means for what I've invested, what can I expect average annual distribution, right? And so, again, what's common is about 7 to 12%. Total return, right, about 100% in 5 to 7 years, if you kind of do the math of that 15% up top. And preferred returns, right? Usually you'll see them in the 6 to, I've never seen 10, but I guess I really have 10 on the slide, but 6 to 8 is really kind of the more typical preferred return. And I know there's questions coming in. I will answer them at the very end of the presentation, right? And we'll kind of go through them. So let's see. So next up, right? Red flags. You as a passive investor, what are some things to look for in any opportunity you're investing in, whether it's us, some other operator, multifamily, self-storage. I mean, all these things, all of the things on this slide, I think apply to any real estate investment. First thing, right? Decreasing population growth, low absorption rates, decreasing rental growth, comps not near the property. Those are kind of very obvious, but those are really important, right? My partner almost likes to joke about Topeka, Kansas. That's become the thing that we joke about. But, if you're investing in a Detroit, right? Yes, people make money in Detroit to this day. And I'm not here to dog on Detroit, but fundamentally, Detroit is a population that is shrinking year over year, right? If I'm going to invest in a market, why will I take that additional risk of not being able to control the population, right? I mean, there are factors that are in your control as an operator or an investor. There are factors that are outside of your control. And ultimately, I like to say that as a investor, regardless if you're passive or active, your job is to really constantly reduce risk, right? And so we invest in growing populations with higher absorption, rates and increasing rental growth, right? And find good, strong comps. And this is where it's really important, right? That's why we invest in Atlanta, right? We love Atlanta. Population's growing, absorption rates are growing. It's got all the things that we look for, and we can buy at the right price. Similarly, Texas is obviously, huge in this spot. But, Detroit's a good example of one that, yeah, maybe a deal can pencil in, but why will I go take that risk whenever I can go find deals in a market that is growing? Right. So something to think about. And you as a passive investor, go do your own studies. There's an insane amount of data out there of top markets to invest in, top population growth. CoStar has them, Yardi has them. Resman, I mean, all these big firms do spend millions of dollars doing these analysis. This data is out there for free. And really to take it, really drive it home, you as a passive investor should dig in and not just look at the macroeconomics, but also dig into the submarket. We all know that the Woodlands is very different than the Heights, which is very different than Clear Lake, which is very different than Pasadena, right? Understand the submarket and what's going on within it, right? So that's on the kind of the macro. Now let's dig into the deal, right? Understand the business plan. Not every deal is the same. We have done deals where our business plan is deep value add. We are taking a property that is rough, emptying it out to 40% occupancy and bringing it back up to 100%, right? There's no cash flow whenever you're doing that for a year. But we've also done deals that are very vanilla, nice, step in, stabilized, operate them effectively type of deals, right? And so understand the business plan and, with that, make sure it's risk adjusted returns, right? And the risk adjusted is important. I think a lot of people look really naively at this versus this. Oh, this one is making more returns than this one. But do you understand the risk that needs to happen for this to work out? There's 30 down units, there's crime, there's all this. There's a lot of things that have to go right in order to achieve these returns versus this deal here. Maybe it's a little bit less return, but it's a lot safer of an investment. So I like to look at any investment that we bring on is it's got to be risk adjusted. It needs to make sense. Right. More than that is just, people that don't explain what are their distribution splits, right? What are their GP fees, right? In addition to kind of the splits, there are fees that GPs charge, and some people kind of sweep those under the rug. And I really hate when people do that. I think all this should be very clear cut for investors up front. There should be no surprises. And ultimately, as I tell investors, I mean, we're protecting you, we're structuring it to where you win, but also, it's a business for everybody. So need to kind of, as a passive investor, I really look for people that are disclosing all that information. Again, there's no guarantee of any of this, people, right? That's why there's a PPM. That's why the SEC has a lot of rules that we have to follow, right? If anyone is guaranteeing your return, you should really question it, right? Instead, I mean, this is where, hey, here's the opportunity. Here's the business plan. Here's the team. Here's the track record. Here's how we're structuring it to where we can make money after the investor. This is why we're comfortable in this deal. And this is why we think it's a good opportunity. That's how it works, right? Another one, really number 4, if someone is not setting aside reserves, right? And reserves is just extra money sitting on the sidelines in case you need it, right? I'd be really concerned, right? These are multi-million-dollar deals, right? I mean, most of the deals we are buying are in the $15 to $40 million purchase price range. And there's a lot that can go wrong, right? You might have a situation where you have a boiler on a property and it's a $50,000, fix, right? Things like that do happen, and needing to have money on the sidelines is important. And that means you need to have more money raised, which means a little bit more water returns from people. Next up is talking through, let's see. So where was I? Unrealistic and average, aggressive revenue growth, right? Unfortunately, it's really easy to make a bad deal look good on paper, right? And this is where you as a passive investor, you need to put your passive investor hat on and start to analyze some of these things. 2 really big metrics, which is really number 5 and 6, that I like to say are the easiest thing for anyone to tweak to make a bad deal look good. And also the easiest thing as a passive investor to look at to figure out if a person's being too aggressive is what are their projections for rent growth and what are their projections for the exit cap, right? On average, rent growth should be in the 2 to 3%. I see some deals that they say, look, it's going to be 5% for the next 5 years. By all means, that maybe that could happen, but that's not realistic, right? And again, it's very, real estate is very location specific, right? I might bite my tongue and I might be wrong. And maybe in an Austin, you can get 4% average for a couple of years. But again, that little percent will change the returns on a deal drastically. And so you as an investor need to realize, hey, is this going to be achievable? And if not, well, now my returns got halved, right? Similarly, the exit cap. And so for those that are new to commercial real estate, what is a cap rate? I'm sure you hear it all the time. I think a lot of people don't really understand it. Right? In residential real estate, how do you value a house? You value a house based on the price of what other houses in the neighborhood are going for, right? Your house is never going to sell for much more than what the neighborhood is going for. That's how residential real estate is valued. Well, with cap rate, you don't have the concept of like for like products, meaning in a neighborhood, all the houses are all very similar. They're almost the same thing. Commercial real estate, not quite the same. You have a storage center, you have a retail, you have a multifamily, and they're very different. And on top of that, maybe the next storage is 10 miles down the road, the next whatever is 20 miles down the road. And again, you can't really just look at the immediate comps. There's just not enough data there. Instead, cap rate is what the way these are valued. And what the cap rate means is basically if I, as an investor, buy that asset and I didn't bring any debt to the table, so let's say I buy it cash, and all I did is I did what the same person before me did in terms of operating it. I didn't get any more efficiencies on operations. I didn't improve anything. I just did exactly the same way the other person did. Then what is my annual return? That means the cap rate. So if I'm buying a property for a 6 cap, let's say it's $1 million purchase, right? That's saying that I expect that the current person owning and operating it, he's making $60,000, 6% on the deal as is. Now, I can buy the deal, I can do improvements, and I can push that income, which will improve my value. But that's really what cap rate means. And maybe to drive it home, the equation for cap rate is basically the NOI, meaning the net operating income, over the value equals the cap rate. And so markets are cap rate driven. Houston is a 5.5 cap market for B-class multifamily in Houston, right? Now, if you remember the equation, so if the 5.5 on the left-hand side of the equation doesn't change, on the right-hand side, you have the NOI over the value, right? What that's saying is, look, if I improve the NOI, I can actually improve the value significantly and stay at 5.5. And so long story short, that's what cap rate is. Now, whenever we model a deal, right, we are looking at what do we think the exit's going to be in 5-7 years from now, right? It's kind of throwing a dart to some degree. You're trying to estimate what the market is going to be because cap rates in Houston really the past couple of years have compressed, right? Across really most apartment multifamily cap rates have compressed across the country, right? And so the question is, if I think in 7 years, if Houston's going to be a 4 cap market versus a 7 cap market, well, guess what? The exit value changes significantly, right? And that really changes the investor returns. And so as an investor, you want to make sure that the exit cap the person is modeling to be safe is higher than what the market is today. And there's some rules of thumb about that, but it is a very, very kind of critical piece to really look at because that can change the deal dramatically. And then again, last but not least, most good operators will do a sensitivity analysis, right? Which is saying, look, we're modeling this deal as a 5.5 exit cap. Maybe it's Houston's a 6 exit cap in 7 years. Well, if it's a 6 exit cap, here's how that will change your investment, right? Again, you as an investor, it's about understanding your investment. And me as an operator, it's about setting the right expectations, right? Nobody is mad if everybody agreed on what the expectations are. People get mad whenever the expectation is here, what gets delivered is here, and now you have misalignment. Let's keep going. So multifamily offering documents, right? So what do you get as an investor, right? Really, there's kind of the PPM. So this is a lot of documentation that the SEC actually requires us to disclose, right? Really, the PPP stands for the Private Placement Memorandum, and it's got a couple of things. It's got the offering, it's got the warnings and disclosures, it's got the distributions and fees, and kind of what does that look like, and then the operating agreement, right? These are the key data points or the key documents that you get as a passive investor, and you should read through them, right? I want to say every, but now I'll say most good sponsors have, attorneys are the ones putting this together. There's a lot of rules around how you collect money, how you raise money, et cetera. And you as a passive investor, this is what you can expect, right? And it helps outline what's the plan for the deal, where things are at. And, if 5 years down the road, there's a problem, right? There's a lawsuit. Well, this is the first thing that gets looked at, right? What was disclosed, what was expected, and did that not align, right? For example, if it says we're going to buy the deal at 123, Sunny Street, and we end up buying the deal at, 123 something else street, well, guess what? We disclosed one thing, we bought the wrong thing. We are at fault, right? And so this is the document that outlines all the key things. It also outlines the sponsorship team too, right? Like I said, Disrupt Equity, we are vertically integrated. We have our own in-house management company. We have a very robust team, and we outlines that who the team is and who's operating the deal and who the managers are, right? Because again, you as an investor are investing with those people. It's about making sure that you know who you're investing with and vice versa. So that's the high level overview on kind of the key things. I wanted to actually drive it home. I'm a big fan of Q&A and case studies, right? So figured we'd do a real case study on a deal that we bought in Atlanta. And so these are a few slides from the actual investor deck that we did many, many years ago for our investors. And it kind of helps showcase what was presented, and we can kind of talk through where that deal landed. So this is a property used to be called Laurel Mill Apartments in Atlanta. Very rough deal, right? But, it's a deal that we bought, did well on, and we exited that about a year and a half ago. So here's the kind of the money slide for the investors, right? This is what was presented. And again, the market 4 years ago, whenever we bought this deal, is very different than the market today. Our returns have softened, right? But on that deal, right, we were expecting 10% cash on cash, meaning what we're distributing to investors. We expect it to hold it for 5 years. And over that 5 years, investors are doubling their money, making 100% return. And, really, we were putting about $900,000 into the property on that property. Right. And we kind of, again, we talked about the location, the management, the high demand, right? We knew the location, there was opportunity. We bought it at a fantastic price point, and there's other deals nearby that were selling at much higher, right? We knew that the person that owned it currently just mismanaged it to death. And I've learned now from that deal, actually, to understand who I am buying from, right? Because that will tell me what I can expect whenever I get into that deal the first 6 months. And then last but not least, we knew there was demand, right? The property across the street had a wait list. This property was, 70% occupied, and really we took it down to 40. And I'll talk about that here shortly. And so, again, you can see the deal, right? This is kind of part of what we liked about it. So to the west of us, there was Walmart, right? And downtown is just west of that. But, you can see that there's a brand new office development going in, right? There was a property where it says right there, purchase vacant. Someone paid more per door for a property vacant than we did. They put 40 a door into it. So they literally doubled what their cost basis is. And they actually ended up selling that for 120 a door. We bought ours for 39 a door, right? So we knew there was some real opportunity there and someone would like that. Then, you can kind of see right across the street, there's a property fully occupied for 2 months, right? And just a wait list. There was a new development right next to us as well. And then we were the red dot. And again, there was a Macy's anchored mall. And, this is back in the days before COVID, before malls really took a hit. Right. But again, we had a lot of things that were attractive that we could see there was upside. It's about getting into this property, operating it effectively, and getting things turned around. And this is what we presented to investors, right? And here's a projected investor return, right? On this deal, we were modeling a refi in year 3, right? And so we basically expected, hey, we're going to go in with what's called a bridge loan, right? The loans that you bring on in multifamily are very important because they can really change the deal. We're going into the bridge loan because it was not going to qualify for agency debt because the property was not what we call stabilized, right? 3 years, do our hard work, do a refi, and then hold on to the deal for a couple more years after that. And ultimately, we ended up doing a different restructure, and I'll talk about here shortly. But this is what was presented to investors, right? Our reversion cap, or that exit cap, we had modeled that as an 8%, right? Atlanta right now today is like a 5.5%, right? I mean, so we were very conservative on that. And really, investors could expect about 50% return on their money over 3 years, right? Once we did the refi. And again, we kind of outlined what we thought we can do distribution wise, each year, cash and cash, and what the whole play looked like, right? This is kind of the gist of the return profile of that deal. Now, that said, I like to say we're opportunistic investors, right? We will take an exit whenever we can, right? Whenever it makes sense for investors. Yes, our play on that deal is 5 years. We ended up doing it in 18 months. And so really to talk about that deal, we ended up cleaning house, right? We took it down from 78% occupancy whenever we bought it to 55. And really, I think we took it down to 40% afterwards, right? So upfront, very first month, brought it down, got rid of the drug dealers, the prostitutes, all of the problem things in this property, right? You got to clean it up and make it a safe, family-friendly environment, right? And it's amazing the transition you could see in a property, right? Like, I remember just going out there, we're going out there every couple of weeks. And what's nice about Atlanta, for those of you that don't know, you can day trip it here from Houston. So literally we'll be on a 7 a.m. flight to Atlanta. We're at the properties by 10 o'clock, and then we take a 8 p.m. flight back to Houston, and we're back, we wake up and sleep in our beds. But it was amazing the transition you could see from month 3 to month 4, right? Month 3, still kind of clammed up, not really people going out. No one's safe. No one's comfortable. Month 4, we got a playground installed. Kids are coming out. We got rid of the right tenants that we needed to not renew and really turn it into a safe, family, affordable, kind of living environment. Right. And so we did bring the security on at the beginning, really just to kind of lock down the property, right? Show the bad people like, hey, we're not, this is not the property to go do your things, go elsewhere, right? We're here to kind of control it. We were able to increase rents, and really in 4 months, we tripled our collections. The money that was collected in 4 months tripled, right? And ultimately we made a sell at the 18-month mark instead of the 5-year mark, right? So about a year and a half in, our investors got about 80% return, total, right? So I mean, did fantastic on that deal. And this is the ugly duckling type of story, right? It's where some people look at a deal like that and they're like, oh, that deal's ugly, it's hard, not going to make any money. But ultimately those deals work, right? And so this is what I like to call a deep value add play. We also do simple stabilized deals. I mean, there's a big gamut of the type of deals that we can get into. But you can see, this is what was presented. This is what we ended up doing, right? But in the PPM, this is what was there. This is what was there, right? These are the slides that actually came from that investment opportunity, right? And so kind of the stats, we raised $1.1 million. We purchased the deal for about $4 million, sold it for about $7 million. So profit is about $2 million, right, on that deal all in. So with that said, that's pretty much the end of my slides, right? So, for those who don't know me, again, my name is Feras Moussa. You guys are welcome to email me, feras@disruptequity.com. We have kind of our website down below. We also have a team email address. We're happy to talk to investors. We're happy to kind of, see if any people have questions. And so with that said, I'm happy to shift over to the Q&A questions. So if people have questions, go ahead and plop them and I'll be happy to answer them.
Yeah, so we got a couple of them coming up, and thank you so much for the presentation. Right. So I'm just going to start kind of reading them through in order. All right. And then I have some of my own questions that I know I always get on the other side. So with the waterfall, who calculates the IRR and how long within like the first 5 years does it take on average?
Yeah, it's a good question. So the IRR, the problem with IRR, right? And this is why I don't like it in terms of for a less sophisticated investor that's still newer, right? Is that the IRR includes the total profile of the deal, meaning the distributions and the sale. So you can't know your IRR of a deal until you've gone full cycle, until you've sold the deal, right? And so to answer your questions, it's really once a deal's gone full cycle, there is a calculation process where things can get settled, right? Oh, did we pay too much or too little, right? If you're over distributing. And so the who is really everybody. I mean, it should be a very transparent calculation. You as a passive investor are more than allowed to ask, hey, can I see how'd that get calculated? But usually, again, you're trusting your operator, your manager, they're doing the calculations and they're sharing that out and saying, look, here's what the return profile of the deal ended up looking like. Here's what investors get. Here's what the sponsors get.
This means, because the follow-up question the same client had was, if the IRR reverts below 18%, then would it shift back to 70-30? And I would assume no. Then is that correct?
Would it shift back? Well, I mean, so if the IRR reverts back to below, then it means it never really got to 18, right? It was, it stays at the lower threshold, right? The lower step in the waterfall is the answer to that.
So just kind of skipping around because I'm trying to do them somewhat in order. Let's see. Let's do accredited investors. Now, I know a lot of multifamily groups have to work with accredited investors only. So if someone was to work with someone like you, do they have to be accredited? A, B, is there an advantage to only working with accredited investors versus non-accredited?
Yeah, absolutely. So, the SEC has rules around, how do you take money from accredited investors and other people? And other people really is about sophisticated investors. And so we have done two different types of offerings, which is called a 506B and a 506C. That's the SEC defined rules. And with a 506C, everybody has to be an accredited investor, right? 506B means we're allowed to get money from sophisticated investors. So we've done both. It's really deal specific. And, there's some other regulations, right? Like with a 506B, we need to have talked. We need to have an existing relationship. I can't get a billboard on the side of the highway saying invest in this opportunity. 506C, you can. So any deal that anybody sees on Facebook and, is being marketed or whatever, there's ads, that's usually a 506C, right? And it's accredited only. So we've done both in our company.
Okay, perfect. So this kind of leads to one of the other questions that popped up. Is there some debate on whether when you're raising capital for multifamily, some groups will raise extra capital. The reason they raise extra capital, right, is to make those good faith payments. Other groups raise exactly what they need. How do you feel about that?
Yeah, so a couple of things. So every group should raise extra in terms of the rainy day fund, right? But that's just modeled in. Now, there's some other gotchas, when this is where it gets really contentious, right? There are some groups that will raise and start to distribute that to their investors, right? There's some quite, because there's a deal that you're buying at a 3 cap does not have cash flow the first year. You're having to do your value add. I mean, there's no way to make cash flow to give to investors, right? But then you see these deals where people model it and they're giving distributions day one, right? So for us, we don't do distributions usually until about month 6, and then from there on we start. And it's really just getting that value created, right? Pushing the rents, dropping the expenses, whatever it is we're trying to do. And so there's some questions around the legality of over raising, right? Because if you think of an extreme example, if I raise $100 million, right? And I just use that money to pay all the investors. Well, at some point that music stops. And so for us, we raise what we need, right, plus our rainy day fund, and then from there out, I mean, we try to raise the minimum because that maximizes the returns, right? As long as we've kind of done enough of the raise to protect the reduced risk.
Now, as we kind of keep going with this, then too,
yeah,
COVID really did change a lot of things, right? And for me, I'm a lender. I love to lend money on fix and flips and stuff typically. And I kind of put a halt to some of that once COVID first hit. So have you seen, as a big multifamily guru type guy, a drastic shift in your organization from, pre-COVID and post-COVID?
We are very lucky that we started Disrupt Management in January before COVID. I'm so happy for that, right? Because we control our own destiny, right? Disrupt Management, we are vertically integrated. It's our management company, which now does third party for other people. So it kind of goes to show that, hey, not only do we operate well, now we have other people that want us to operate their deals. And what that allowed us to do is to be nimble and be quick, right? I think property management, I think the next 10 years is all about the operator, meaning the people that can actually operate their deals effectively, not just ride the gravy train that is the market, right? Those are the people that are going to do well. And so we've doubled down. We spent a lot of time and energy really building a very unique management company. I think that's really excelled. And that through COVID, that allowed us to pivot and do very well. And so to be honest, our deals did not do, our Texas deals did not do they did not do poorly. They did pretty well overall compared to other people. And I mean, we, just started distributions actually last month again on some of these deals. And so, overall, actually COVID, yes, there was a dip, but there was still cash there. And really, it's ultimately about helping your tenants help themselves, right? And that's really what it boils down to. A lot of people, a lot of operators don't have the gusto to put in a plan to help tenants apply for aid, help tenants get things, help tenants put together some sort of payment plan, right? Because people ultimately want to live where they are. They're happy to try, right? And it's about creating a win-win. It's not about just evicting everybody. So, we were pretty diligent and every week going through all the delinquency summaries and figure out what can we do for each person. So overall, I mean, was there a dip? Absolutely, right? And that's across the whole market. But I think we fared better than I expected, and we fared better than most people. So,
all right. Now, can you talk a little bit more about absorption rates and how it can affect the analysis of any type of investment or deal?
Yeah, so absorption rates gets a little bit complicated. So think about it this way. If I have a property that I'm buying, right, and the day after I buy it, 3 apartments get built across the street. Well, guess what? I have to go compete with those people, right? And usually with a new apartment, right, those guys have to give what's called a concession. Concession means, hey, they're going to give a month for free if you move in, things like that. And so now that affects me. And so absorption rate, really what it means is how quickly, can a new property get absorbed in a market, right? How quickly are people getting absorbed into that unit, that property? And so it's just something to keep in mind. And to give you guys an example, we're actually in the midst of doing a deal here in Northeast Houston, and love the deal, love the area, right? But it's definitely, there's still land around there. And I know there's new developments coming online. And so going into that deal, I know that, okay, the first couple of years, we might have to deal with just some competition from newer developments, right? Even though we're a 30-year-old development, 30-year-old property, we're still going to compete with those newer ones because there's not much inventory in that area, right? But the long run perspective is actually, makes sense, right? A lot of improvements in that area, so it's a short-term pain for a long-term gain. So it's something just to be aware of, right? Versus right now in Houston, if you're going to, Houston's had some issues around absorption in the A-class market, right? A-class they've all been killing each other with concessions, right? Very concession heavy the past year. And so just being aware of that. And again, we'll buy an A-class in Houston. I'm not scared of it, but it's just something to be aware of. And you model that in, knowing the first year or two, as absorption kind of tapers off, there's, you're not going to be able to stay, very, very occupied.
Now, this one I'm probably going to end up answering, but I'm just going to get your take on it. If someone's using an IRA, now we're not talking about the solo 401k, but if someone's using an IRA in any one of your investments, they're going to bring on UDFI, right? And so is there steps that you take, or is there steps that we can talk about to help eliminate the UDFI tax?
So that's a complicated one, right? So we stay out of that, right? So our job is really, we work with the investor to get them, their annual valuation, right? All the other pieces that they need, the mechanics of it. Really work with your CPA to structure things correctly around, how are you investing, what entity, what other pieces, right? And how do you, help with that? So I'm sure, Derek, your team probably are the experts in that, answering that question in terms of
No,
what is the most common way people mitigate that.
Yeah. So, and just to kind of piggyback on what Ferris was saying, right? It's not his job to help alleviate your taxes, So you always want to talk to a good CPA. And the person that asked the question used the term like, hey, for self-directed IRA, how do we avoid UBIT? Well, your IRA is actually bringing on something called UDFI, or Unrelated Debt Finance Income Tax. UBIT is the overall picture, and UDFI is a small subdivision of what you're bringing on. To give you an idea, if you're working with a CPA and they keep referring back to it as UBIT, UBIT also applies to churches, nonprofit organizations, hospitals, and they could be calculating things the wrong way for you. All right. So first thing is make sure if you're speaking with a CPA, make sure they're familiar with the proper terminology and then looking it up the right way. The second thing to understand is UDFI is more something to be aware of and not something to be scared of. What people forget is all you heard was, I have to pay a tax. Well, normally when your IRA does an investment that is zero tax, there's no taxes that apply to the IRA, then you don't get to take tax deductions. You don't get to claim, interest rates or HOA fees and things like that, or claim losses potentially on the K1, right? Well, once you bring in UDFI, you get to claim all of these things to help offset any type of taxation. So make sure, and we teach a whole class in this area. Let me know, send me an email if you want. I'll put my email down in the chat box below, just so we can talk a little bit more about it. Ferris, I'm going to let you.
Actually, I want to touch on that really. I mean, Derek, what Derek is saying is really, really valuable. I highly recommend people get educated about it, right? I think the problem with the real estate is education. People need to get educated and learn about it, right? And understanding the gotchas is really important. And this is where, don't just get a CPA first, getting a CPA, get a real estate oriented CPA, right?
Boom.
I mean, don't do your own taxes to save a few bucks, because a good CPA will save you thousands of dollars, hundreds of thousands of dollars, right?
I learned that the hard way.
Make that investment, do the right thing and go get educated on that, because it's, as much as I know, and as thousands of investors that ask me these questions, I mean, it always starts with, it depends, right? And it's complicated. And I don't know anywhere, I still lean on my CPAs and my network to kind of help with these kinds of things. And so it's important, because again, the last thing I hate to see is someone thinking they're going to get a huge loss or huge write-off and then didn't structure, or they weren't in a setup to be able to actually take the benefit of that. So
Ferris, can I get you to click on the Q&A box down below? Because you got so many of them and you got plenty of time.
Yeah. So here, I'll just go. So do you want to ask them, or want me to go ahead and read them out and I'll answer them?
No. So I want you to kind of skim through them real quick and see if there's a way, because they're kind of all over the place,
Yeah, I'll just read them top down and just knock them out. So I'm good with that. So first one, Brian, how are the favorable tax consequences for current year relevant using an IRA investment with the tax specifics are deferred until distribution? So the tax specifics are deferred until distribution. That's not entirely true, I guess, unless you're talking about just getting a big loss and how does that apply to your IRA? You get a K1 each year. That K1 has usually a loss, right? And kind of what's going on with the deal, right? And maybe people to realize it's not about just getting infinite losses, right? There is something called the catch up at some point, right? And so this is where whenever you exit a deal, you have to be smart and understand, okay, am I gonna have to pay back all that money, or is there something I can do? That's where 1031 comes into play and some of these other concepts. And so the losses are there. It's about you and your CPA understanding how do you continue to benefit them. And this is where get the right CPA.
And Brian, I just posted in there my email, because you and I can talk about that separately off this, because that leads down to a different rabbit hole. But I can talk about that with you, Brian. Send me an email.
Yeah, cool. Perfect. And actually, maybe one quick thing, just to give, maybe not to give ourselves a shout out. We do have a toolkit that we put together around, basically that kind of actually outlines a lot of these tax pieces. So if anyone's interested, check it out, disruptequity.com/toolkit, right? And it's just kind of a passive investor piece that has a lot of things around what are the resources, what are the things to look for. So disruptequity.com/toolkit. I guess I should have a slide about that one, but let's keep going.
Yeah.
Omar, my friend Omar, I know Omar. What is the difference between return on investment and return of investment? This is a great question, because this is a gotcha almost, right? A lot of operators try to be sneaky around how they model their returns, and return of my capital is very different than return on my capital. What does that mean, Ferris? Okay. So now if you invest $100,000 in, let's say, in one of our opportunities, right? That the value of your investment stays $100,000 throughout the life of that deal, right? Until usually a refi or sell. Now, there are some people that'll say, look, you invested $100,000. I gave you $10,000. Rather than being a return on your investment, that's a return of your investment. And what that means is now your $100,000 investment is actually $90,000. And then the next one's 80, so your investment's actually dropping, which means to pay you 5% on your $100,000 is very different than to pay you 5% on your 50,000, right? And so it's a way to kind of reduce what we call kind of the investor capital piece. And there's a lot of kind of reasons around why operators try to do that, right? It favors it more on the operator side of things. And so something to be careful. And this is where read your operating agreement, specifically read how it talks about distributions, because there will be steps around here's what happens, step 1, step 2, step 3, and read what it talks about around sales and refis. Those two things are really, really important, right? Because it really explains what happens to that investor equity pool. So I think that's a great question. All right. Next question. Is your strategy to buy B-class multifamily, improve them, and sell for profit, or do you hold long-term? Our strategy is both, right? Most deals we're positioning them 5 to 7 year holds. And then from that, right, we'll take an exit where we can. The deal I gave in the show, the case study I gave, right, that was positioned as a 5-year that we did in a 1.5 years. And so this is where it goes back to we're opportunistic, right? If there's a way to make a really, really strong exit for investors, why would I not make that exit versus holding on to the deal, right? Yes, we'll hold on, we can cash flow, everybody's still happy. But ultimately, the way I look at it is I can give investors back a huge return. They can take that money and put it into 3 deals, right? And again, start over again. So, but yeah, our investment strategy is usually that B minus, B plus space is kind of where we're shifting in. We've done a lot of C and we'll still continue to do C class investments. We're trying to focus more on the Bs. So next question, I have a self-directed IRA and bought single family homes with it. How can I sell those and buy into syndications? Catherine Malley. So
Catherine, you got to start listing the properties.
Yeah, I think it's sell the properties, you get the capital back in your IRA, and then, there's a process around, we give you paperwork and then you give that to Quest IRA and they help. And Quest is really, really fast, easily the fastest IRA on that piece. But there's a little bit of paperwork that gets provided that you send to Quest and then give the approval and then they'll wire over the money. So,
and then Catherine, just to kind of piggyback on that a little bit, I notice a lot of times one of the biggest issues people have when they're trying to sell their house and they can't get rid of it is they don't have a good realtor, right? Or they're trying to do something themselves. Find an investor-friendly realtor, right? And if you're in Texas, send me an email and I can email you over a couple of them, let you choose which one you think works best for you. But I work for a girl named Danielle Drake or Morad Fiki or, and there's a few other ones out there that are really good with investors to help get rid of those properties, get the cash back. So.
Absolutely. All right. Let's see. So Tim Rayborn says, for passive investor, if there is a pref, would you only invest if the pref is cumulative? Yeah, absolutely. So that's a really good question and I'm going to explain what that means. Derek, did you have something you were going to add?
No. Go ahead.
Yeah. So what does it mean for a pref to be cumulative, right? Let's say we have a deal. We don't distribute anything year 1, right? It's an 8 pref deal. So year 1, we didn't distribute anything. Year 2, we start distributing. Let's say we distributed 6%. Well, if it's cumulative, it means we still owe 8% from year 1 and 2% from year 2, right? Where it's you as an investor are looking for net return, right? And so there's the sneaky thing where people say it's non-cumulative.
Uh-oh. Ferris, I think your internet cut out. Ferris? Beep, beep. No, I think we lost Ferris. Hey, Juan Rivas, can everyone else still hear us and see us? Someone give me a good thumbs up or say yes, so you can still hear me and see me. Yes, thank you, Todd. I appreciate that. Hopefully Ferris comes back on here in just a minute. So if he doesn't, guys, make sure right now you take his email down. It's right there on the screen. He's been a good friend of ours, and he has a big event coming up called the Multifamily Investor Network, right? And as his network starts to, or as his event starts to come up and play, he's offering everyone actually a free ticket to it if you set up an IRA. So he was going to say that at the end of this, but we didn't get to that. We'll see if he comes back on. He may not. If anyone else out there has any questions on how to use an IRA for some sort of multifamily investment, have questions on getting one established, right? Or if you have some of those more tough questions like UBIT, UDFI, please reach out to me, let me know. Feras, I see you just jumped back on.
Yeah, hey guys, I apologize for that. It looks like my computer my MacBook decided to crash arbitrarily. So called in from my phone while the computer gets back online. But I was just on a roll with those questions. So
yeah, no worries. So I was actually just talking real briefly, just while I still have you on here. Can you talk about your big investment summit coming up?
Yeah, absolutely. So we do have, great question, Derek. So, 2 years ago, we realized that there was not a good event in Houston specifically around creating an environment and culture for people to learn about multifamily investing, right? No sales pitch, no guru, none of that. Is really about educating people and getting them exposure. So, that's where kind of Multifamily Investor Network was born about 2 years ago. And we've since, we try to do 3 of these a year. So one in Houston, one in West Coast, one in East Coast. The last one we did was last February. I forget what it was the date, but it was basically last February, right before COVID. We had 400 people out. We had Mayor of Houston, Sylvester Turner, came out. And really, it's about creating an environment for people to get exposure, get educated, and learn. And so we did decide to do our next one. We kind of canceled the West Coast, East Coast, but we are doing the next one here in Houston coming up at the end of the month. So February 27th. Would love to have people come out. So it's mfinvestornetwork.com.
So,
and
you have your website for it pulled up right now, just so some people can kind of see and see all the speakers and individuals you have coming in to talk about it, right? And if you guys notice on here, and I just want to make a quick comment before you say too much, is Feras, it's no secret. You have raised capital before for multifamily investments, correct?
Correct.
Awesome. So now when I go through this, if we look on here, there's other big key speakers in here that raise capital for the same thing. Robert Martinez, Ryan Gibson, right? We brought in these 2 individuals on right here to many of our events prior. So, Feras, why are you not scared of bringing in competition to talk about these things?
No, great question, right? For us, it's not about, it's not the Disrupt Equity show, right? It's really putting together an environment, let investors learn and educate. And, and it's not to say one operator is better than the other, right? We're really a we're not a scarcity mentality. It's a come one, come all. And, to me, the more educated my investors are, the better they are, right? And if they're getting, they learn from me or learn from other people, by all means, right? Not everybody is going to click with everybody, right? Some people will naturally gravitate to one person. So, I think it's a win-win-win. And, the other thing is it helps us build relationships with these other people, right? Just like getting the mayor of Houston out there. It helps us build a relationship with him that we never, thought we could build. So it's really about putting together and creating value for people, period. And I think our investors see that and appreciate that.
And we do too, right? Because a lot of times people think in real estate that it's a cutthroat type deal where, oh, it's my deal, it's no one else's deal. And they don't realize that you need to build a network. You need to be able to talk with other individuals that are doing the same thing because you guys can help one another out. You really, really can. So I see on here the tickets are $150. Is that correct?
Yeah, if you use the coupon code out there. So yeah, cheapest you can get them is that.
So right before you dropped off, I was talking about if someone wanted to use their IRA and work with you or set up an account with us and stuff and go through these motions, could you get them a discount on that ticket?
Yes, absolutely. If anyone goes ahead and sets up an IRA, I'm more than happy to give them a free ticket to that. So definitely happy to help support Quest IRA. You guys have been a fantastic sponsor for us, so happy to always try to share that back out.
So I just want everyone to realize that if you want to go to the Multifamily Investor Network, okay, and there's 130 people on this event right now, and checking out all of these cool speakers, reach out to me and I will put you directly in contact with Feras and we can talk about what the next steps are as far as either setting up the accounts, getting you to one of these events, those type of things. So Feras, any last minute statements and stuff before we go?
No, so more spoiler, I'm back on the video, so back on the computer, so able to kind of make that transition. No, hopefully people got value from that. I know there was more Q&A, and if people have questions, feel free to send me an email. Happy to answer those over email or have the team kind of reach out to people. But, thank you, Derek, for you guys for, fantastic company, easy to work with, and, all this very supportive. So, I like to say Quest IRA was pretty much one of the first sponsors we had at the conference 2 years ago. Continue to sponsor it since then. And so, we'll be glad to have you guys back on here soon.
Awesome, man. Well, thanks again for joining us. And I hope to see you at that conference here in just a few weeks. So
perfect. Thank you, Derek. Take care.